talking about the budget. Well, it was certainly promised as a revenue-raising budget, and it seems that was the case. So we certainly saw some measures which will, in theory, raise some taxes. We'll have to wait and see whether the proof is in the pudding, whether they actually do, because there's always a bell curve with taxes. You can try and raise rates, but where there's a ability to plan around them, then sometimes tax take overall can go down. So it remains to be seen whether raising measures actually do raise taxes, but certainly that's what we were promised beforehand, and that was certainly what came out from the announcements there. So I'm going to delve straight in. So I'm going to be covering sort of direct taxes, and then we'll hand over to Kelly to look at things like VAT, etc. So it seems largely a private client budget. There were a few business announcements, but mostly the announcements seem to affect shareholders of family companies, essentially, seem to be the biggest losers here. So what I thought I'd touch on is just some headlines from the inheritance tax and capital gains tax measures, and then go through some of the other changes as well. So just as a reminder, inheritance tax is currently charged at 40% on value above 325,000. So that's assets left in the estate. If you're making lifetime gifts to trusts, that's 20% of the lifetime rate, and that can come back into charge if you pass away within 7 years. If you're just making straightforward gifts, not into trust, then there's no immediate tax on that. But there can be if you pass away within 7 years, it's brought back into your estate. So that's broadly how the inheritance tax charge works. That 325,000 has been frozen at that value since 2010, and they've announced that it will remain at that level until at least 2030. So that's 20 years of an unchanged threshold. Even since 2010 till today, inflation has been around 50%, and so to have no increase in that at all is why we refer to it as fiscal drag, that more and more people will find themselves in that inheritance tax net. They do say only about 4% of estates pay inheritance tax, but that is largely focused on the southeast of England, based on property prices alone, really. So those are all frozen. There's no changes there. So what changes did happen? So there were two key reliefs that we rely on a lot in inheritance tax planning. There's agricultural property relief and business property relief. So agricultural property relief is what stops farmers having to sell up every time somebody in the family passes away. It enables them to keep it in the family. Business property relief can relate to sole traders, partnerships, shares in trading companies, and indeed farmers themselves, if there's value in a farm outside of the agricultural value. So business property relief is slightly broader than agricultural property relief, but it was previously 100% in a lot of cases. So in unquoted trading company shares, in partnership shares, sole traders, businesses, they would qualify for 100% relief from inheritance tax. The government decided as a revenue raising measure that they're going to limit the 100% relief to the first 1 million of value. And then after that, the relief will be limited to 50%. There are certain assets, such as a commercial property owned outside of a business, owned personally, but used inside a company that the property owner also owns, that currently qualify for 50% relief, and that relief will also remain in place. So that bit hasn't changed. It's just the 100% relief that's going to get restricted. So that's going to have a rather sizable impact on family companies. So if you've got companies that are valued above £1 million, then you're going to have an issue there. We're still awaiting further detail on that. There's a consultation coming out on these changes. As of now, they're saying you won't be able to, for example, in the same way when you pass away, you can transfer your 325,000 nil rate band from one spouse to another. It looks like you won't be able to transfer your £1 million between spouses, but remains to be seen in the final legislation. There are some details still to come. For AIM shares, what they've said is, and other AIM shares is in particular is one they gave as an example, but it's basically any sort of shares that are on a stock exchange somewhere, but they're not quoted, so they're not on a FTSE share or anything like that. So on the smaller share exchanges, those shares are no longer going to qualify for 100% relief either. They will be limited to 50% relief, but they won't qualify for the £1 million 100% relief threshold. So they will immediately go into the 50% relief. So that's a bit of a dampener for anyone who set up an AIM listed portfolio trying to mitigate their inheritance tax. It will still reduce the inheritance tax, but it'll be limited to 50%. It may mean that people have to sell their AIM shares to fund IHT liabilities on death, and therefore, it may have an impact on the AIM market if people are selling more often. Further announcements on that then, pensions are due to come in to the IHT net from April 27. So at the moment, anything left inside a pension that's been untouched, anything that's been left inside a pension will be outside the scope of inheritance tax at the moment. So anyone passing away from now until April 27 will still qualify for that exemption. Okay. Bits we don't quite know yet are particularly sort of around trusts. So how that will work for trusts. So there has been announced that trusts can qualify for the £1 million business property relief. So trusts have inheritance tax charges when they're set up. They have inheritance tax charges when capital leaves the trust, and they have inheritance tax charges every 10 years. They have said that the £1 million will qualify for the trust. How that works in practice, how will it be apportioned? What if you set up different trusts on the same day? If you set up a trust every 7 years, do you get another £1 million? These sorts of questions, we don't really know yet how that's going to work. So there's a consultation on that to be issued early in 2025, and then we'll find out more in due course. Okay, so these changes are due to come in from April 26. So at the moment, the relief will still be available. So there is still time to move things and qualify for business property relief, and utilise the relief whilst it's still here. But after that, these changes are due to come in. We are, because of the size of sort of the changes in inheritance tax, we will run a separate webinar on inheritance tax at a date to be confirmed, most likely in early 25, once the new announcements have been made, and we get a clearer picture on how things will work. But we will come into that in a lot more detail in a separate webinar. So the other change that really quite affected family businesses was capital gains tax. So at the moment, just to remind people that higher earners, so that's sort of 40% taxpayers, income taxpayers and above, pay 24% on things like second property gains, and they pay 20% on profits from other assets like shares. So that's the picture as it stands at the moment. For basic rate taxpayers, those rates are 18% and 10% at the moment. Well, so I said were 10%. From budget day, those rates have changed. So the rates have equalised, so that now the rates on residential property and the rates on all other assets will be the same. So it'll be 18% for basic rate taxpayers, 24% for higher rate taxpayers. So the one exception to this is carried interest. So Labour did make it clear, even before they were elected, in fact, that they were not a fan of what's called carried interest, which is essentially an interest in a fund that's owned by someone who works in that fund. So people come and invest in a fund, but the people who actually work there also are able to benefit from any growth and payouts from that fund, and that's referred to as a carried interest. What Labour were concerned about is that if you work there, why isn't that taxed as employment income, is broadly the picture. For everyone else, if you invest in a fund, fine, it makes sense. It's capital gains tax or dividend taxes that are paid out for distributions that are paid out. But if you work there, why is that wealth, not that accumulation of earnings, not taxable to income tax? So as an initial step, they've said anyone who sells carried interest will pay higher rates of tax. So they've immediately increased that to 28% for capital gains tax in this current tax year. They'll increase it to 32% from April. And then after that, they will issue another consultation to see how they can essentially bring that within the income tax net. So if you've got a carried interest, the chances are you'll be paying significantly higher rates of tax on that going forward. Now, the other big one, of course, was the business asset disposal relief. So business asset disposal relief, which was previously called entrepreneurs relief, and frankly, most people still call it entrepreneurs relief, was a relief for people who owned shares in essentially unquoted companies. And that's trading companies. It counts towards profit, so partnership shares as well. And if you sold your sole trader business, you can qualify as well. So you need at least 5% of the shares in the company, because typically companies we see it on. You need 5% of the shares. You need to work in the company in some capacity. That can be as a director or as an employee. And you need to have done both of those for at least 2 years prior to sale. So previously, if you did that, the first £1 million of the gain arising qualified for a beneficial 10% rate. That is due to be increased to 14% from April 25 and then 18% from 2026. So there were fears of business asset disposal relief being abolished altogether. It's still in existence, but it's just not quite as generous as it was, only giving you a lower saving than before. Previously, it was a 10% saving. It'll end up being just a 6% saving when you compare the 24% normal rate to the 18% business asset disposal relief rate. So it has been curtailed, but not completely abolished. So other key measures then. So one of the big announcements then was that the increase in employers' national insurance. So at the moment, employers pay national insurance at 13.8%. This is going to increase to 15%, and that will affect basically all employees. Anyone who has an employee will then end up having to have an increase in national insurance. Stamp duty land tax. There was a 3% surcharge on second homes introduced a few years back. This was intended, the intention behind this legislation is that homes don't sit empty, is the intention behind it all. So the idea was that if somebody buys a second home without having sold their first main home, they will pay an additional 3% SDLT. If they then sold their previous main home within 3 years, they can claim back the extra SDLT that they've paid, because they've then behaved themselves by not having two homes. Unfortunately, the way it worked is that you could be in a situation where you had your main home but also wanted to acquire an investment property. Because you then hadn't disposed of your main home, the investment property was then also subject to the 3% surcharge on second homes. This 3% is going to be increased to 5%. So from the end of October, it has increased to 5%. So anyone buying a property from now on will end up paying, a second property will end up paying an additional 5% on top of the normal SDLT rates. Now, in addition to that, you've got things like non-residents also pay an additional 2% stamp duty at all levels. So if you're non-resident, that 5% is in fact 7%. They also applied this 2% increase to non-natural persons. So essentially what they also don't like is companies buying homes that you then live in. So rather than having any outright ban on that or anything, they apply certain taxes to companies acquiring homes that are then not rented out or not being redeveloped for onward sale. If you're buying them and they sit empty, and they're worth more than £500,000, then stamp duty land tax was charged at 15%. This is going to increase to 17%. So just to reiterate, that doesn't apply if you're buying an investment property that's going to be let to a third party. You can claim an exemption from that and just pay the normal SDLT rates. But if you are buying it as a place to live, then it's a cliff edge, and that anything over 500,000 will then be immediately mean the entire purchase price is then liable at 17%. The non-dom tax changes. So these were previously announced rather than being in this budget, but it was just sort of reiterated that they are going to continue with these plans. There's quite a few changes going through. There's quite a bit of detail there. Again, with this topic, because of the amount of detail involved, we are going to have a separate webinar on this one at the end of the month, in fact, in 2 weeks' time. So if anyone's interested in that topic, we'll cover that in a lot of detail in that particular webinar. But as there wasn't too many changes to that announced at this budget, we weren't going to go into too many details on that this time around. We spoke more about that in our previous budget webinar. Similarly, just some more things that were confirmed. Furnished holiday lets. They were previously a beneficial tax status for furnished holiday lets, mostly around the capital gains tax regime, to be honest. So a furnished holiday lets was one that was let on short-term lets, had to be let for, it had to be available to let for 7 months of the year, and actually let for 5 months, 4 months. Sorry. But so it enabled the person who owned the furnished holiday to claim it as a trading asset, which meant on sale it could qualify for the 10% business asset disposal relief. It also meant you could gift a furnished holiday let down the generation and claim holdover relief without paying CGT on it. But it was announced that this status is going to be abolished, and it's been confirmed that it will be abolished from the 6th of April 2025. So furnished holiday lets will no longer be a thing. Anyone letting on short-term lets, it will just be exactly the same as a long-term investment property. So it will become an investment asset. Just a note on tax rates as well. So income tax rates and thresholds, they've been frozen for quite a while, for 3 years already. They will be continue to be frozen for up to 5 years until 27, 28. And at which point it's intended they will increase with inflation. Presumably at that point they think they will have inflation under control, so therefore they're not so worried about increasing it at that point. Corporation tax, it's also been announced that it will be frozen at 25% for the duration of Parliament. So we should basically have a bit of certainty over what it's going to be. So even if we see some further tax cuts coming out of the US, that normally spurs us into action, but it seems like Labour have committed to keeping that at 25% for the duration. Okay, the last couple of things. So state pension is set to rise by 4.1%. That is above the CPI. So normally the state pension goes up by the September CPI inflation rate, which was 1.7%. So that's actually a real-time increase in this case. I'll leave Kelly to talk about what the VAT aspects of things, but just as I'm sure people are aware from headlines that there will be VAT on private schools fees going forward. So before I move on, can we run our poll at this point, Kay? So of those sort of measures that we've mentioned, the key ones, I just wanted to see if people had an idea of which one the Labour government would expect to raise the most money from. Okay, are you there?
What makes me sound?
Okay, you're able to run the poll now.
It's running, Tim.
Okay, thank you.
Just, I think you can't see. You need to push the poll widget. You should see it. But essentially, everybody's said that 100% would be changes to national insurance.
Fair enough. Okay, good. So yes, that's exactly right. Yeah. So the changes to the national insurance are going to be the biggest revenue raising measure that they've announced. So whilst it's only 1.2% compared to some of the other measures that were announced, then it will be the largest rate to rise, and we'll go into a bit into why that is in a second. But I just sort of want to also highlight some good and bad things. Sometimes I'm clutching a little bit at straws in terms of the good things, but we've got some in here anyway. So, so just some good things that came out for businesses. Capital allowances on electric cars is going to be maintained at 100% for the following tax year. It was going to be limited to the end of this current tax year. So that essentially means if you buy a company car that is fully electric, the company can get a 100% deduction in the year it's acquired. That treatment is going to carry on into the following tax year, 25-26. Every company that has employees is going to be entitled to claim the employment allowance. Previously, this was capped for sort of smaller entities, so only smaller entities could claim what's called the employment allowance. This was a £5,000 allowance that you could deduct from your employer's national insurance costs. So this £5,000 has been increased to £10,500 and will now apply to all employers. So according to the government statistics, that will mean around 800,000 employers will actually pay less national insurance than they did before. So if you've got a low employer's NI tax bill that's covered by that increased allowance, then indeed, yeah, you will pay less. But for slightly larger employers, with the increase in the rate, it's likely to be a significant increase overall, to be honest. Just a small thing, but it's that we've actually, this was just something that we were looking at not too long ago. HMRC put out some guidance around what are called double cab pickups. So they're pickup trucks that have a load bed on the back that can be used as a van, but they're called double cab because they have a front row of seats and a back row of seats, and therefore you could in theory get a family in there. So the question's always been, does that amount to a car or a van? Because if they're cars, then you can't get things like you can't get what's called annual investment allowance. You can't get 100% deduction for capital allowances. There's also an increase in the benefit in kind if the employee uses that van, double cab pickup. Personally, HMRC put out some guidance and then withdrew it a week later. So they've decided to make it clear once and for all that a double cab pickup will be considered a van, regardless of payload or anything else. So that's a slight good news, probably mostly affecting farmers. To be honest, they're very common in the farming industry. Fine, then moving on to the next one. So to go with the employer's NI increase, it is going to still be possible to salary sacrifice part of your salary in return for a pension contribution by the employer. So rather than taking, I don't know, say it's £1,000 of salary, you can say to your employer, you keep that and pay it into my pension instead. So you can reduce your salary by that amount. It's called a salary sacrifice. And because you haven't been paid that amount, they won't pay the employer's NI on that. So there'll be a saving for the employer of 15%. If you're the employee, fine, you might want to say, can I have a share of that saving? But at least it means there is a way to slightly mitigate the national insurance increase, and that hasn't been curtailed by the budget. That's still available. So yes, the increase to 15% in the NI though. So not only did they increase the rates, they also sneakily reduced the threshold at which you start to pay it. So at the moment, you only pay secondary contributions at 15% if your earnings are above £9,100. They've reduced that threshold to £5,000. So that means essentially there's pretty much an extra £600 of national insurance from everybody who's being paid at that sort of level. So if you were previously receiving an NI3 salary of £9,100, the company will now have a £600 national insurance liability on that amount. Now, the slightly sneaky thing is that it was common planning for family businesses to pay a very modest salary of around that sort of figure, the 9,000 figure, or perhaps the 12,000 tax-free allowance, depending on preference. But the point was, as long as it was above the lower earnings limit, which is around 6,500, it qualified for state pension purposes, even though you didn't actually pay any national insurance, either at the employer or employee level. Whereas if they're going to reduce the threshold down to 5,000, it means that if you do want to stamp a year for state pension purposes, you will need to pay at least the lower earnings limit, which is around 6,500. It changes every year. But it will mean the employer will have a 15% liability on that. So we've previously done a lot of remuneration planning for clients that involved just taking a small salary and not having to worry about having any liability on that salary at the directors for that company, at least, director shareholders. That may need to be reviewed to see whether that's still the best option for them, particularly with there not being any increase in dividend rates. So to go with the increase in national insurance, so it steers people towards taking larger dividends than salaries. So as already stated, there's unlikely to be any reduction in corporation tax. At least there's not going to be any increase, I suppose. But and then we've already talked about the increase in SDLT rates for rental property. So if you've got a rental property business, you'll be paying higher SDLT on any new purchases. You'll be paying the extra 5% surcharge rather than 3% surcharge. So private clients, is there much to actually say? Probably not, to be honest. So as I said, we will cover the non-DOMs and changes in remittance basis and international things further on a separate webinar in a couple of weeks. But one just thing to think about though is that previously the non-DOM remittance basis regime, which was quite a beneficial regime for individuals coming to the UK for the first few years they were here, was only really open to people who didn't have an origination, a heritage from Britain. So if you came from overseas, born overseas to overseas parents, that was really what it was designed for people to come to the UK. Under this new regime, because we're looking solely at residence rather than domicile, it will be possible for returning British expats to claim the remittance basis. So for the first 4 years, they will be able to benefit from a beneficial income tax system. It will also mean people who are previously domiciled in the UK and therefore liable to worldwide inheritance tax can start to shake off their inheritance tax burden by being outside the country. You most likely need to be outside the country for 10 years to remove the inheritance tax charge for non-UK assets. But as I say, we'll go into more detail on the inheritance tax side of things in a separate webinar, most likely early in the new year. But it just means, essentially, the point is the non-DOM changes aren't just applicable to non-DOMs. There are UK people who will be able to benefit from these changes if they're looking to move overseas or return to the UK, having been out of the UK for a long time. So yeah, and then just the other thing. So whilst there was national insurance increases for employers, so employees are likely to suffer that, even though you cannot discharge your employer's NI liability to an employee. Realistically, it may cut into future salary increases. It may mean employers say, I'm not going to increase it by 4%. I'm going to give you a 2% increase instead because I can't budget. I've got the same amount of budget for the salary increase, and therefore I'm actually going to have to reduce your salary increase in the future. But for self-employed, because they announced a 2% cut in Class 4 NI previously, they're going to maintain that, so that it will remain at 8%. There was no corresponding increase in self-employed national insurance. So, there's been a lot of talk. So originally, the Conservatives were talking about abolishing Class 4 national insurance entirely. Previously, there have been thoughts about whether national insurance for self-employed and employed should be equalised. At this point, again, we've got quite a sizable disparity between national insurance for self-employed and employees. Okay, so lows for private clients. Yeah, so we've probably touched on most of these, to be honest. So the business asset disposal relief, people were kind of expecting a change there. It was mooted a lot, certainly we were expecting some. At least they weren't, the CGT on other rates wasn't increased as high as income tax rates as they have been in the past and are in other countries. There's going to be significant changes to IHT, so inheritance tax from 26, as we've said, and we'll watch out for the consultations. Pensions coming within the scope of IHT for quite a few years now. I think it was 2015, 16, around that sort of time. It's when pensions came out of the IHT tax net. So people have been using them for quite a while to plan for inheritance tax, and to have that pulled from underneath our feet is going to be a bit of a hit. So people have been building up pension pots as a way of avoiding inheritance tax. There'll be it's unlikely to be any sort of grandfathering clauses there. So anyone who just has a pension pot and passes away after 27 is likely to be caught by these inheritance tax changes. And then just a small thing on the electric cars. So for quite a while now, electric cars have been, there's been an encouragement for people to start driving electric, and therefore in the tax system, the benefits in kind of being given an electric car by your employer has been very, very low. It's set to increase to 9%. So that's 9% of the cost of the car, or the original market list cost of the car. So it's going to be quite an increase, considering it was 1% just a couple of years ago. So the benefit of having an electric car is starting to be curtailed. The concept behind it was they wanted to encourage people to get into electric cars by 2030, with the mandating that all new cars cannot be petrol or diesel cars going from that point forward, and they have to be some sort of alternative fuel. Then they no longer need to have the incentive in the system, the benefit in kind system, and therefore we will see an equalising of the benefit in kind rates over time, and that's just starting to take place now. And after 2030, I would expect to see further changes there as well, to increase them further. Okay, so that's sort of the highs and lows. Just a few little things that also they crept in, which I think are worth knowing about. So late payment interest. It's always been said by HMRC and government that late payment interest, so if you pay your tax late, they obviously charge you interest on that. They've always said this is just to put the government back in the position that they should have been if you'd paid your tax on time. And for as long as I can remember now, probably the last 15 odd years, they have pegged late payment interest at 2.5% above the Bank of England's base rate. So for a long time, it was pretty low, obviously with the 0.5, 0.25% Bank of England interest rates we had for a while. Then, it was pretty low at that point. At this stage, it's quite a high interest rate, around 7.5%, because it takes a little while for the 2.5% adjustment to be made once the Bank of England announce it. But what they've said is they're going to increase that 2.5% to 4%. And it's pretty clear in their sort of costings of the budget that they expect that to actually bring in quite a few billion quid. So to try and still say with a straight face that interest is not a revenue raising measure seems a bit two-faced to me, because that's clearly why they've increased it, and they're trying to raise revenue, and they've done it for that reason. But just to be warned that interest on late paid tax is going to go up. There's also going to be a new reporting regime for crypto assets, both domestically and internationally. So at the moment, we have something called the Common Reporting Standard, where banks and other financial institutions have to report information to the relevant tax authorities. So obviously in the UK, that'd be HMRC, but Swiss banks have to report to the Swiss tax authorities, the US to the IRS, that sort of thing. So each country's local investment managers and banks have to report locally, and then that information is then shared internationally. So if you've got someone who has a Swiss bank account that's got a connection to the UK, the Swiss tax authority will then share that information with HMRC. So to try and level up the playing field, they're going to introduce a similar system for crypto assets. And therefore, to move with the technology, move with the times, people are investing in that a lot. So in the same way, at the moment, we have it for interest and dividends and things like that, we're going to have that for crypto assets going forward, and we'll see what that looks like. But that is on the horizon, that will happen in the next few years. So making tax digital, it's another topic that probably warrants a session in itself. So making tax digital is a system whereby HMRC have it in their head that for some reason small businesses are the ones that get it all wrong and are not paying their correct share of tax. So because of that, they want people to report on a quarterly basis under Making Tax Digital, and they want everyone to have digital records, which is why it's called Making Tax Digital. So this is due to come in from 2026. They've confirmed they're going to go ahead with that time frame. Initially, it will be for rental and sole traders, unlisted and unlimited partnerships as well. So not LLPs, not companies. So it'll be landlords, sole traders, and unlimited partnerships will have to adhere to Making Tax Digital. So at the start, the turnover threshold will be £50,000. So if you're turning over that sort of number, you will have to adhere to the rules from the 6th of April 26. They had announced it was going to go down to 30,000 the following year, but they've just said it's going to go down as far as 20,000 by the end of this Parliament. So they're going to bring more and more people into this net of having to report on a quarterly basis with a final true-up at the end of the year. But it also means that pretty much everyone will have to have some form of accounting software. And if you're only doing £20,000 of rent and that's your only source of income, that does seem quite a burden to me. But yeah, we're going to do some further announcements and further guidance on Making Tax Digital in the near future. There'll be more from us on that. One last thing for me. So the official rate of interest is not the interest on late pay tax. It's what they apply to loans if you take a loan from a company or if you're given accommodation by your employer. It's a rate of interest that applies to those benefits in kind. It has, for reasons I'm not particularly clear, been maintained at 2.25% for the current tax year. I thought it'd be increased significantly, bearing in mind where interest rates are generally. But I think for that reason, they've decided that rather than setting a rate for the year and realising it's the wrong rate, they're going to review these quarterly. So now we're going to have to keep an eye on every quarter what the official rate of interest is going to be. So that will be for benefit in kind, loans, accommodation. It can also apply to things like benefits from offshore trusts as well. So if you're on that sort of sphere, they can be affected by that as well. So yeah, that's been a bit of a canter through the changes. Obviously, I'm available to take any questions on that. So let me just see if we've got any in there. No questions yet. No. So in that stage, then I'll hand over to Kelly.
Thank you, Tim. Huge amount for you to get through there. Significantly less on the VAT and indirect taxes. So thank you for sticking with us to this point. So just really the main change in VAT is that VAT will apply to private school fees with effect from 1st of January 25. And this was announced back in July by the Chancellor, but we've had in the lead up to the autumn budget and in the autumn budget itself, just some more information and clarification around things like timings of tax points, when private schools will need to account for VAT on private school fees, and also what will fall within the charge to VAT and what will remain within the VAT exemption. So we'll just look at that in a little bit more detail. So what HMRC and the recent budget announcement have confirmed is that all education, vocational training and boarding services provided by private schools or connected persons in the UK for a charge will be subject to VAT at the standard rate. What they have confirmed is that the supply of goods and services closely related to a supply of education or vocational training, other than boarding, will continue to be exempt. So there's been a lot of discussion by private schools about what will remain within the exemption and what will come out of it. With school meals and transports being sort of a key concern, how should VAT be dealt with for those items? And HMRC have suggested that where a separate charge is made for school meals and transportation, that will remain within the exemption and will not be subject to VAT. but that does depend on a separate and distinct charge being made. HMRC's guidance does talk in detail about single and multiple supplies, which is something that private schools would not have to have concerned themselves with up until this point. But in the VAT world, we understand as businesses that where you make a supply which is made up of a number of elements, but one of the elements is the predominant supply, then the VAT liability of that single supply will take on the VAT liability of the predominant supply. So in this context, if you're looking at a fee for private education, what HMRC is saying is that if you sort of scoop up a whole load of other services within that single fee, then it will all be subject to VAT. Whereas if you carve out separate supplies and charge separate fees for each distinct supply, then each distinct supply will be subject to VAT at the rate that is applicable to that supply. So it's important that private schools really do carve out those elements that could still be capable of falling within the exemption to keep the cost down for those paying for private school education and associated services. So in terms of the VAT registration, whilst the VAT on private school fees was announced back in July, HMRC did say that they would not be accepting any applications for registration until the end of October. So while some providers were trying to, get ahead of the game, submit their applications for registration so that they could all be ready, HMRC had a policy not to process any of the applications until the end of October. They are now processing those. And I guess one of the key things is that private schools need to be very clear about the date of the registration, effective date of registration. So whilst the charge to VAT is effective from the 1st of January 25, to the extent that private schools anticipate that the value of their taxable supplies will exceed the registration threshold of 90,000 within the next 30 days, that will create a liability to be registered for VAT on the date from which that expectation arose, which could lead to errors in the date of VAT registration. And where there are errors, so say, for example, that the registration was applied from 1st of January and it was actually required at some point in December, that could lead to penalties and interest. So it's important that private schools are aware of the key dates. So as I just sort of ran through, where there's an expectation that within the next 30 days, the income in relation to private school fees will exceed the VAT registration threshold, the effective date will be the date that expectation arose. And HMRC give an example in their guidance where a school receives 100,000 for tuition on the 8th of December for a term starting on the 6th of January. The effective date of registration there is the 8th of December and not the 6th of January. So, it's not huge amounts, but schools need to be mindful of these little sort of quirks of the legislation and the required dates of registration, so that they don't fall foul of that and get penalties and interest before they're even registered. HMRC say that charging VAT at the standard rate of 20% doesn't mean that schools have got to increase their fees by 20%. So they're trying to rally and say, whilst we're saying that school fees are subject to VAT, this is not an absolute cost to those people paying school fees. And what they say is, which is true, is that private schools charging VAT will now also be able to reclaim VAT paid on their inputs, so their purchases, such as capital expenditure and purchases of educational supplies. Because if you take a step back, the way that the VAT regime works is that where you incur costs in relation to onward taxable supplies, so in this instance, incurring costs in relation to taxable school fees, the VAT on those costs will now be recoverable. So actually, because schools are now able to reclaim a certain amount of VAT that previously they wouldn't have been able to reclaim, that effectively offsets the 20% cost. So HMRC estimate that after recovery of VAT on their costs, on average, schools should be liable for VAT amounting to approximately 15% of fee income, although they do appreciate that this will vary between schools. So just looking in a bit more detail about the kind of things that schools might be able to reclaim VAT on, a key one that we've identified is VAT on capital expenditure. And this really could give a significant benefit to private schools who have or are going to incur capital expenditure for their schools. So, for example, we have a client who incurred a significant amount of capital expenditure on a new property, a new building within the private school campus. They incurred about a couple of £100,000 worth of VAT 5 years ago. They weren't VAT registered. They had no entitlement to be VAT registered. But a capital asset in VAT speak has a 10-year lifespan. And so 5 years on, the school now finds itself in a position where it is liable to register for VAT, and it has a capital goods scheme asset, which still has 5 years left to run. So on the basis that it incurred £200,000 worth of VAT on the construction, and there's half of its capital life still to go, potentially there's £100,000 worth of VAT there that can be reclaimed over the remaining 5 years of the asset's life. So for that school, we are, once the registration is in place, we will look to make those claims. And that's been really important to the school, because understanding the level of the VAT reclaim has enabled them to think about how much of the VAT cost they will need to pass on to student families, and how much they can absorb, knowing that they're going to get a repayment from HMRC. So if you are a private school provider and you have incurred capital expenditure with a value over 250,000, or you will be doing so, then that's certainly something that you need to consider. I guess a final point on private schools is that because with effect from January next year, there will be making a combination of taxable and exempt supplies, and just sort of recapping, the taxable elements will be the private education, and the exempt supplies are things that are goods and services closely associated with that. So things like school meals, transportation, and other associated items. The making of both taxable and exempt supplies will mean that these schools are partially exempt businesses. So it puts them now in a position where they can reclaim some but not all of their VAT, and they'll need to carry out an apportionment known as a partial exemption calculation to work out how much of that VAT they can reclaim. There are a couple of different methods. There's a standard method, which is a values-based method. and that sort of very broadly says, well, what's the value of my taxable supplies, so the value of your school fees, over the total value of supplies, so school fees plus other exempt supplies, meals and transport, and then express that as a percentage and apply that percentage to your VAT on purchases. Very simply put, that's how they would need to do it. There are also special methods that can be used, but I guess the thing to take away is that for private schools who have never had to been VAT registered in the past, they now are VAT registered and they're having to deal with these complexities. So, you know, it's something to be aware of, and also to make sure that they're maximising the amount of VAT that they can claim that is available to them now. So key takeaways, I think, from the VAT on private schools: effective date of registration. Whilst the charge to VAT is effective from 1st of January 25, clearly the date of registration could be triggered before this if fees and income is received before then. So private schools just need to be aware of that quirk, and their liability to be registered might be before that date. Also potential for VAT capital goods scheme reclaims that can help boost the coffers of the private schools at this time, which is likely to be very welcome. Some supplies will still be treated as VAT exempt, but the schools need to be careful about really stripping out those supplies and charging separately for them in order to be able to maintain that VAT exemption. And then finally, a requirement for private schools to carry out an apportionment to work out how much VAT on purchases they can reclaim, and that's all around partial exemption. So those are the key things for private schools to be mindful of. So just really to swoop up any other indirect tax changes since the budget. First of all is the vaping tax. So back in March, it was announced, or there was a consultation announced, which was looking at how to tax vapes. That consultation has now happened, and the autumn budget confirmed that there will be a single duty rate applicable so at a rate of £2.20 per 10 ml of vaping liquid. That's going to take effect from October 26, so just under a couple of years' time, and businesses will need to be registered for approval within that scheme, and they can start registering in April 26. So that's good. It sort of puts vapes on a par with tobacco products. And then another one which has been identified, which will be effective from 1st of January 27, is a carbon border adjustment mechanism. So this tax will place a carbon price on goods at risk of carbon leakage, which are imported into the UK. So that is deemed to be aluminium, cement, fertilizer, hydrogen, iron, and steel. And I certainly have a couple of clients that fall into those categories, importing those types of goods. At the moment, we don't know what the tax is going to look like, how it will be charged, but it certainly is coming into effect within or just over the next couple of years. So we will keep an eye on the developments there and keep you updated. And then finally, just usual increases across other indirect taxes. Air passenger duty increased in line with inflation for economy flights, but for higher classes of private charters, that increase has been significantly more than inflation. Tobacco duties, again, increases across the board, higher for hand rolling tobacco. Alcohol, there have been some duty cuts to draft products, but otherwise increases to all other alcohol products in line with inflation. And then just confirmation that the tax stamps for spirits regime will be withdrawn with effect from 1st of May 25. So that was a scheme designed to circumvent perceived avoidance in the spirit sector. Presumably that has not brought about the benefits that it envisaged, and so is being scrapped. I know that did cost the spirit sector a huge amount to implement that scheme. And then finally, just increases in line with inflation for other sorts of indirect taxes, including soft drinks levy, plastic packaging tax, landfill tax, aggregates levy, and climate change levy. So that is a very quick roundup of the VAT and indirect taxes changes in the budget. I will hand over to Kay just to sign off, but thanks very much for joining us today. And if you have any questions, I'm not sure, we have a couple of minutes left, but otherwise you can contact us via the website chat or email addresses provided on this webinar as well. So thank you very much.
Thank you very much, Kelly, Tim. Thank you. Brilliant as always. If you haven't yet downloaded a copy of our budget report, you can see it there on your screen. It's on our website in the publication section. There are Kelly and Tim's contact details on your screen for you now. Again, they can be contacted via our website. I can see my inbox is already filling up with requests to attend the non-dom webinar and the IHT one, which Tim mentioned, which will run early next year. So if you would like to be put on those lists, please do get in touch. Thank you very much for your time, and we all wish you a lovely afternoon. Thank you. Bye-bye.